Welcome once again to Fun and Gains, Road to Your Financial Future. This is episode 3. Don't miss the starting gun. The subtitle is The Importance of Time. Time is one of the 4 key factors stressed by John Bogle, which I outlined in the previous episode. Another subtitle might be, How much do you need for retirement? Now, when I first made the notes to prepare for these episodes, I figured I would just say, save for your future early and often, and that would be it. Everybody would agree. But apparently, that is not sufficient. Let me speak some words from the Pink Floyd song, Time. Oh, by the way, one thing you don't want to hear is to hear me sing. You are young and life is long, and there is time to kill today. And then one day you find 10 years have got behind you. No one told you when to run. You missed the starting gun. There's a lot of truth in these words, at least when it comes to investing for your future. Unfortunately, it looks like thrift has not been a common virtue in the United States, at least over the last 20 years or so. Now, what really got my attention is the August 3rd, 2009 issue of Business Week. It featured the incredible shrinking boomer economy on the cover. And a sidebar in the article simply said that 69% of baby boomers aged 54 to 63 are financially unprepared for retirement. The article also says that boomers have been the biggest spenders in history. All of a sudden now boomers are starting to save, but they missed the starting gun. Now, how bad is it really? Is this just media hyperbole? Alan Garner, an assistant vice president and economist at the Federal Reserve Bank in Kansas City, wrote in the first half of 2006 that personal savings declined from about 10% of disposable income in the 1980s to 1.8% in 2004, and actually went negative in 2005 for the first time since the Great Depression. And this data comes from the National Income and Product Account data, which is compiled by the Department of Commerce. Garner takes several pages of economic speak to actually conclude, and I quote him here, that the decline in the personal savings rate may not be as alarming as it appears. Well, we should all be alarmed based on the Congressional Research Service, the CRS reports, and other studies that support the 69% unprepared metric from the Business Week article. According to the CRS, a very large number of Americans give little or no thought to saving for retirement and have accumulated little, if any, retirement savings. They will have to work well past retirement age if they can find a job as an old-timer or be totally dependent on Social Security once they retire. Now, a recent report from actually April 11th, 2011, on a poll conducted by the Associated Press in conjunction with lifegoesstrong.com says, and I quote here, the 77 million strong generation born between 1946 and 1964 has clung tenaciously to its youth. Now boomers are getting nervous about retirement. Only 11% say they are strongly convinced that they will be able to live in comfort. A total of 55% said they were either somewhat or very certain they could retire with financial security, but another 44% expressed little or no faith that they'll have enough money when their careers end. Now, we can go back to the CRS reports to get some, I'd say, a more numerically accurate picture that reflects what's being said in that poll. And this report was titled Retirement Savings and Household Wealth, Trends from 2001 to 2004, updated May 22nd, 2006. Now it says, when we take into account households that had no retirement account and thus had retirement account balances of 0, a total of 11.7 million households headed by individuals 55 to 64 years old had retirement savings of $88,000 or less in 2004. This represents 68.3% of all households headed by persons who were 55 to 64 years old in 2004. So to put the overall retirement status in perspective, the CRS report notes that for an individual retiring at age 65 in May 2006, $88,000 could purchase a level single life annuity that would pay $653 a month, roughly $7,800 per year, based on the federal thrift saving plan current annuity interest rate of 5.375%. Now this amount will replace just 15% of the median household income of $53,400 among households headed by individuals who were 55 to 64 years old in 2004. And I have to note that at today's interest rates, the annuity probably would be much less than 15% used in the report, but I'm going to use their figures. So if you use Social Security will replace about 40% of their income, and we're talking about the people who retire. And so they will have to live on roughly 55% of their previous earnings when you add the annuity plus Social Security. And I ask you, if you retire tomorrow or next year or even a few years from now, if you could live with a 45% pay cut. Too many people are not prepared for retirement, and they have just about run out of time. Do not let this happen to you. Now, the CRS also reported the status before the financial and housing debacles of 2008, and undoubtedly the picture is worse now. And we get some idea from the AP Life Goes Strong poll, and I quote here, overall nearly 6 in 10 baby boomers say their workplace retirement plans, personal investments, or real estate lost value during the economic crisis of the past 3 years. Of this group, 42% say they'll have to delay retirement because their nest eggs shrank. So many people are facing severe retirement shortfalls simply because they gave little thought to retirement savings or lacked the discipline to actually save enough. Now, when you're starting your career, 30 or 40 years looks a long way off, and it is. So it's really important to spend some time talking about time and how it can work for you or against you. In addition, adhering to John Bogle's list of virtues, let's see how we can set some realistic expectations, and more importantly, look at setting realistic savings goals. CRS published another report, very thorough and well done in my opinion, and it is titled Retirement Savings, How Much Will Workers Have When They Retire? And this was done by Patrick Purcell and Deborah Whitman. And the value of this report is based on actual household income data and historical investment return rates. And thus it provides a pretty realistic estimate of retirement savings that people need to achieve during their working careers. And the big message is, start saving as soon as you start working. And I quote here, and this is from Purcell and Whitman, as the data presented later in this report will demonstrate, workers who wait until middle age to start saving for retirement face an uphill struggle in accumulating adequate retirement assets. Now, Purcell and Whitman start with a snapshot of the current state of household retirement accounts. And I'm just going to show the data for two age groups, the 45 to 54 group and the 55 and older. The actual data is, by the way, comes from the Federal Reserve Board of Federal Reserve Board Survey of Consumer Finances. And based on the accumulated retirement balances, the picture is really not that pretty. 50% of the households 55 and older, I call these retirement households, have accumulated retirement balances of $119,500 or less. 75% of these retirement households have balances of $373,000 or less. And the picture is probably now bleaker because, as we mentioned before, there was a huge stock decline and housing decline from 2007 to 2008. The big question is, what should the picture look like? And what should you try to achieve for your retirement accounts? The best we can do is to start with some assumptions about earnings, investment returns, and volatility. That's rewards and risk in John Bogle's parlance. The contribution rates, and then run Monte Carlo simulations. Monte Carlo, by the way, is a computational technique developed by physicists on the Manhattan Project during the 1940s. It was used to estimate outcomes for what I'll call multi-pass situations and based on probabilities. And for financial simulations, the results typically provide a spread of different outcomes with different likelihoods. So this is what the CRS report authors did. And the result is, I think, a realistic set of estimates over a range of possible future outcomes that are based on real-world data. Now, if you want for more detail on this, you can go take a look at the report. And I'll show the URL at the end of the session here. This chart that you see is extracted from the charts in the CRS report. It shows estimated retirement savings in 2004 dollars at age 65 of a married couple with median household earnings of around $52,000 at the time. That contributes 8% of pay annually for 20 years, 30 years, and 40 years by investment rate of return. It assumes an investment mix of stocks and bonds, which are adjusted for age, along with the historical rates of return for these asset classes. And they use a median real rate of return of 5.5%. The blue bars show returns for a 20-year saving period, the red for 30 years, and the green for a 40-year period. And from looking at the chart, it's clear that the longer you save, the better off you will be. But focus on the 50th percentile, or the median return, which is the most likely return. And using this median return, your retirement balance at the end of 40 years would be $844,000, just a little less than double the $468,000 balance at the end of 30 years. And that qualifies as way better off in my book, and clearly shows that the best thing you can do is start your retirement saving early. The calculations that generated the chart above provide an estimate of the absolute amount of retirement funds. Thus, another very important conclusion is that married households at the median income levels, in this case, need to target total retirement savings in the neighborhood of $500,000 to $800,000, and this is in 2004 dollars, by the time they retire at age 65. Now, from looking at the chart, you can also see there's a 5% chance of accumulating over $2 million at the end of 40 years. Now, this is not likely, but the odds are far better than those for winning a lottery, so put your lottery money into your investment account. Now, it's also much less painful to save 8% from the very beginning than if you have to make up shortfalls by increasing your savings rate in later years. And in those later years, your expenses are likely to be higher and saving is going to be tougher. So earlier, I compared retirement income stream to the 68.3% of households with the $88,000 or less in retirement savings to a 45% pay cut upon retirement. This is an example of what is called the earnings replacement rate. And it provides a relative measure of your potential retirement income, your income stream, let's say, to your current income. And it may be a better way to help you view how well prepared you are for retirement. So if you take your average earnings a few years before retirement, compare an income stream generated by your retirement assets to this pre-retirement income, you get some idea of probable standard of living in retirement. So very simply, the equation, you can see the equation on the screen. That's pretty simple, really. Now, as before, the retirement income stream is estimated by calculating an annuity. And CRS used a life annuity, which insures the purchaser and his or her surviving spouse against longevity risk. The CRS calculated the percentage of pre-retirement earnings that would be replaced if the household's entire retirement account balance were converted to a life annuity. Now, annuities are generally sold by insurance companies. There are many kinds of annuities. They're not always a good deal. But this is a useful estimate, I think, and a good way to get a more immediate picture or feel for the level of savings and how well it will provide in you in retirement. So don't expect to keep your standard of living when your income drops. You also have to take into account Social Security in this equation, and today there's certainly a lot of question about what the program will look like 20 to 40 years from now. But the table you see shows Social Security Administration estimates for the immediate future. And the administration estimates that for a career-long average wage earner retiring at full retirement age, Social Security will replace about 41% of their career average earnings. And actually, for a lot of reasons, people start collecting Social Security between the ages of 62 and 65, and they do not receive the full benefits, and thus ultimately have a lower total replacement rate, at least the Social Security portion, when they stop working. So here's where Bogle's virtue of realistic expectation comes in. What do you realistically expect for yourself over the course of your career? Now, since the CRS report has based its calculations on the median wage, we can use 40% as the replacement for Social Security as an example. Now, this means that your retirement savings have to contribute 60%, especially in your early retirement years, in order to maintain parity in your standard of living after you retire. Now, I've used data calculated for married couples in the chart that you see. The CRS report provides data for single persons as well. The CRS report authors use Monte Carlo, as I mentioned, simulations for estimating the accumulation of retirement funds over contribution periods of 20 years, 30 years, and 40 years. And I've copied the data for the average wage only because the screen size just is too small to show everything. Now, the chart brackets the results of thousands of trials from these Monte Carlo runs. So let me take a moment to explain what you see here. The y-axis shows the replacement rates as a percentage of the median wage 5 years before retirement for married couples. Now, the blue diamonds show kind of worst case. That is, 5% of the simulation runs generated investment return that could fund a very low replacement rate. And on the other side, the green triangles represent 95th percentile and replacement rate that is very high and also very unlikely. So focus on the red squares. These show what Fortuna is most likely to bestow based upon past history. And as you can see, at the 8% annual savings rate, you can't get to the 60% replacement rate unless you save and invest for 40 years. So realistically, you need to save 10% for 30 years or 8% for 40 years. If you miss the starting gun, you will have to save at an even higher rate. There is a hidden whammy here. The report notes that stock returns are highly volatile, which we all know. If you start investing early, you can accept more risk and place more money in stocks. As you age and get closer to retirement, you should risk less in stocks. Now, Burton Malkiel's advice on stocks is that you have to be able to hold them for 20 years or more to be, and I'll quote him here, to be sure of earning the generous rates of return available from common stocks. John Bogle says that the percentage of bonds in your portfolio should be the same as your age. So the hidden whammy is that the later you start your program, your savings program, the less you should risk in the higher reward asset classes such as stocks, and the slower your retirement funds will grow. So you have less time to accumulate funds at a lower rate of return. You cannot control Fortuna, but you certainly can control the time you invest, and you can control the amount you invest. And in a nod to Lady Fortuna, the CRS report says, and I'm quoting again here, households can decide when to begin saving for retirement and how much to save. But variability in rates of return is beyond their control and yet has a great impact on their assets at retirement, which is what we just saw. The bottom line is most workers in the United States will begin to saving more of their income if they wish to maintain a standard of living in retirement comparable to that which they enjoyed while they were working. Take heed. Time will work for you. Don't miss the starting gun. Now, this is probably one of the more tedious sessions that I warned you about. I went through a lot of detail from the CRS reports and really to help you understand the significance and the importance of starting your retirement saving as soon as you start working. So let me end with a quick summary of this episode, the road to your financial future, and list a couple policy guidelines that have emerged. The summary is really short. Building an adequate retirement balance requires 30 to 40 years, virtually your entire working life, of steady saving and investment of at least 8% of your income. Now, for policy guidelines that feed off that, really, number one guideline, start saving early, invest 8 to 10% of your annual income in your retirement program every year. Number two, for married couples, your target for accumulated retirement assets should be $500,000 to $800,000. This is in 2004 dollars, and as inflation increases, your target amount will go up a little bit as well. So don't miss the starting gun. Time is on your side if you muster the discipline and start your retirement saving early. Now let me just do a little segue here. When I was in the Army in basic training, the instructors always talked about basic fundamentals. And I still remember this because I always thought it was a bit redundant, but it got the point across. So the next episode is basic fundamentals of investment calculations. See you then.